But the problem is that if you had 5 million shares before you got started, and then you issued 100 million shares that have never been in the public markets, and in many cases, people don't even realize how many shares have been sold necessarily in the private markets. There's just, to us, no real clear way of beating that dilution that's naturally going to come. Some of these companies, one of the companies that's actually moved in on our floor in our building, they had 3 million shares before this merger, and they were a marketing company. And they have issued 200 million new shares to go become a Bitcoin treasury company. And so 99% of all the stock that's ever been issued has not been public. And so our thought is, as those things become public, the dilution effect is going to be too high, and many of these names are going to suffer. So these are some of those examples. Strive is the one that's on our floor. They raised $750 million, created 346 million shares. And so they've created 21 times more shares than they had before this, and the pipe has not been registered. So most people don't even know about how much dilution is coming. And the concerning part on top of that is the terms that many of these companies are pitching to their investors. They're saying, hey, we're doing this pipe, but there's not going to be any lockup. And so when these shares become eligible for trading, I think anybody who's spent any time in public markets knows what's going to happen. It's going to be this massive wave of dilution that, despite their best efforts, I think they're going to struggle to stay ahead of that. And so there's some very good examples of how this typically plays out. There's a trust called the GSOL Trust, which is a grayscale trust that owns Solana. So during periods where there's a lot of demand for Solana, the price of the trust does separate from the underlying value of the trust. So what you're seeing in this dark line is the price that it's trading at. And what you're seeing in this gray line is its net asset value. And so over here, you're seeing some examples where the price is 100 and the net asset value is 10. So there's a 900% premium to net asset value. A lot of these treasury companies are looking like this right now. And so people are jumping in thinking that they're going to capture this massive spread. But as the liquidity in the market increased, you can see literally in a matter of days, it comes right back down and then fits right back in with its real value. And the pitch that many investment firms are making to their investors, we've heard a few of these pitches already, is, oh, well, worst case scenario, you're just going to get this like underlying asset. So what's the big deal? What they don't realize, and what has happened many times in the crypto space and in traditional closed-ended vehicles like this, is those things don't just go to NAV. Many times they go to a discount. So they go from a massive premium to a massive discount. And that's actually what happened with the largest Bitcoin trust a couple of years ago. It was trading at almost a 40% discount to NAV because so many of the people that had bought that trust had bought it with leverage. So when that leverage unwound, it didn't matter what the NAV was. There was just so much selling in the market that it came all the way down to negative 48, I believe was the highest number. And then, yes, over 2 years, it kind of rose all the way back to its net asset value. But those investors got crushed during the process with all that leverage, and they were not part of this run up. And so there's some pretty clear examples of how some of these things play out.